Al, how the heck are you doing today?
You know what? Today I am doing fantastic. Actually, I think every time we do the show, I'm doing fantastic. So
Is there ever a bad day with you?
No. Well, yeah, I've had one bad day. It was about 10 years ago, but I got over it.
Well, I'm glad you're having
I'm doing well now.
It's because I'm doing really good. It's because we're talking about the financial markets. That's why you're always having a great day.
Yeah, there really is never, if you know what you're doing, there really is never a bad day in the market.
You're right. It's always a good time being back, helping our listeners make better investing decisions. And Al, we had another great week in these financial markets. The momentum is almost feels like it's kind of slowing down a little bit, especially with this S&P 500. That's been sideways for the past about 4 weeks now. The NASDAQ has been showing some weakness, but the Dow has been showing some strength. So there's a lot of indecision out there. The dollar, that's continuing to lower right around the $90 mark. Oil that showed a little more strength this past week here again near the highs from March, around $65 per barrel. Gold and oil were pretty good. Had a stellar week with gold that was around $1,800 or so this week. Silver at about $27.30, give or take, some change here. So we're seeing a lot of great moves in the market, and some things that could be slowing down a little bit. But with all that indecision and market volatility, you need the proper tools to make proper investing decisions. You need the right tools, but also the proper rules. Let's talk about some of that today. But before we do that, let's get into these market conditions. What's going on? What's causing a lot of this volatility, a lot of this indecision, and some of the momentum slowing and others gaining?
Well, yeah, there is kind of a change going on in the market right now. We always say that the four most dangerous words in the financial world are it's different this time. But right now it is a little bit different. And what I mean by that is that it's the players that have rotated a bit. The markets have always been controlled by the institutions, by the hedge funds, the big players. Right now we're seeing kind of an outflow of their money from the market, but an overall inflow, which means the retail traders are the ones that are really putting the money in the market and kind of moving it. So that's why we're seeing a little bit of change here. You're seeing a lot of people in the market, many for the first time, that are they're trading with emotions.
Well, that's always, though.
That's always
especially
the case
retail.
With the retail traders. The pros don't trade with emotions. The pros trade against the emotions of the retail traders.
Yep.
So right now we're seeing a lot of people that are piling money into the market. A lot of them because they got stimulus checks.
They call them stimmies.
Stimmies, and we're seeing a huge number of new accounts. Robinhood often has between 150 to 350,000 new accounts a day. And those are a lot of the people that are coming in without experience. But what they're doing is they're looking at what this market has done, and it's done very well. And they're putting money into things that oftentimes they don't know anything about, but they're willing to take a risk, I guess, to see if those things do well. But the institutions, we're always going to get back to kind of a normal situation where the big money is going to be controlling the activity and the movement of things. But you kind of hit it on the nail, or hit the nail on the head when you said have the right tools and the rules. A lot of people, when you say rules, they're saying, what do you mean by rules? Well, it's the pros, the institutions that are really setting the rules. And they're setting those rules in their favor, And their number one rule is, hey, don't lose money. And
if you do, keep it small.
Keep it small, because everybody knows you cannot be right 100% of the time. But if you do this right, and the pros know how to do this because they set the rules, they have the right tools to use, and they understand that if they're wrong, their principal's protected, and if they're right, their profit is protected. But they also know where the proper entry is to give them the opportunity to have better chances to have their trades move in their favor. But it's really great to see all these new people involved in the markets and realizing what the value of it is. I guess our urgent message to those people now would be get an education, learn what the proper tools are to be able to benefit, not just in a market that goes up, which this one has. The truth is markets never will go all in one direction forever. There will be times when there will be pullbacks. There will be times when the market is flat. For most people, especially if you don't have the education, you only know how to participate if the market is going up. there's strategies, there's tools you can use in down markets and sideways markets, oftentimes to do better than the opportunities in an up market.
Yeah, what is the term for using that opportunity in a down market is actually called shorting.
Sure.
And essentially, go ahead and explain that.
Yeah, you can say that is a tool that you can use if the market is going against you. If you look at odds, you want to put the odds of being odds in your favor of having things go your way. If there are three ways that something can happen or three directions something can go in, and you're only participating in one of them, that doesn't put the odds in your favor. That's 1 out of 3. If you can participate in all three directions, that's 3 out of 3 opportunities, which really puts the probabilities, the edge in your favor. And what we want to do is make sure that you understand how to do that by using the proper tools. Shorting is one of them. When the market is going in a downward direction, heading south, then you can short, you can participate in that market by actually selling something at a high price with the intent of buying it back at a low price. And we go into detail in this. It's a concept that most people have a hard time understanding, but when they see it and they understand it, it's a great tool to use.
Yeah, it's basically the same thing as instead of buy low, sell high, buy low.
Exactly.
It's just the opposite, but the concept is pretty much the same. But to do that, you need to understand proper market timing, and where you find that is on in a price chart. So you want to follow price, not emotions within the financial markets. Al, we've been talking a lot about, what are the proper tools that you need for trading and investing. Coming up in the next segment, I want to talk about what the smart money, the people that know what they're doing, what type of tools are they using for trading income. So coming up next, tools for trading income. We'll be right back.